Hello and welcome to the third of three videos which make up this quarter's investment update. In the first video we looked at what's been happening in the economy, and in the second one we looked at how that has affected some of the various asset classes we invest in. This one is going to look at how portfolios have performed and how we've positioned them in light of those changing market conditions. Now in this video we'll be concentrating on our core portfolios, but there is more detail about all the other portfolios in the written version of this report. Now, as always, we say investing is for the long term, so we're going to start by looking at long-term investment returns. So this table shows the 10-year returns of our three core funds. They are up between 48% and 77% in total over 10 years. And as always, we can compare that to other places you might have invested your money, and we need to compare it to those that take a similar amount of risk. So for example, we're looking at portfolios that have a similar amount in the stock market to our portfolios. And the typical balanced fund, for example, that can have between 20 and 60% in stocks, returned just under 45% over that period. Of course, you could have invested your money with another wealth manager instead and asked them to build you a bespoke balanced portfolio. And the typical wealth manager's balanced discretionary portfolio returned basically the same as a mixed investment fund over that period, 45.5%. So at the top level, we can say we've done better over the long term than comparable investment managers. Now also on the table is what that works out as on a compound annualized basis. And then we also show what inflation has been over that time period. And despite that recent spike in inflation, where don't forget it got over 10% in 2022, over a decade, it's averaged 2.9%. And that means that even with the very difficult market conditions we've seen over the past couple of years, all the portfolios have grown in real terms as well. Now, of course, you could instead have left your money in cash. And had you done so, then your total return would have been just around 12% over 10 years, or about 1.1% per annum. That's gross of tax, had you got returns in line with base rate. So apart from anything else, hopefully that demonstrates why we think it's so important to invest. Because leaving your money in cash, even over the last decade, would have seen it shrink in real terms by close to 2% per annum. So that's the long term, which of course is most important, but of course things have been much more volatile in the past couple of years. So we're going to look at the various different timeframes as well. And pleasingly, again, even if we look at shorter term timeframes, things are definitely moving in the right direction. So this table shows performance against both wealth managers, which are the ARK indices shown on the table, and against mixed investment funds. And for example, if we look over 12 months, the portfolios are up between 8% and 11%. Now, all the portfolios are outperforming both wealth managers and other mixed investment funds over the short term, like 3 months, for example. And the same can also be said over the long term if we look at the 10 years. And even in the middle part, the 3-year period, that's which began basically close to the recent high points, and therefore it includes all the negative returns from 2022. We're now back to roughly flat in all the portfolios. So now let's look at where these recent returns have come from and how we've been adapting the portfolios to those changing market conditions. So this table is based on the balanced portfolio, but other core funds have seen similar moves, just different magnitudes. It shows what our current allocation to each asset class is and how that has changed from a year ago. It also shows roughly what return we've seen from that part of the portfolio. So we'll start by focusing on fixed interest, which is the likes of corporate bonds and government bonds. Now over 12 months, we increased the weighting by 5% to 45% of the portfolio. That is our highest ever weighting to fixed interest, which reflects our positive outlook. And you can see returns have been decent, with our fixed interest funds up nearly 9% over the last 12 months. Now, if you'd watched video 2, you'll know that government bonds have not done very well over that time frame. So it's corporate bonds that have provided most of the returns. In particular, high yield bonds have seen some excellent returns, in many cases more than equities over that period. So this increase to our bond allocation has partly come from a reduction in real assets like property and infrastructure, where we've seen some mixed returns, with property recovering somewhat from 2022's losses, but infrastructure struggling more recently. Over 12 months, we've slightly reduced defined returns exposure. We did actually increase it quite a bit in the autumn at relative market lows, but since then we've seen a few products kick out, and as markets are now much higher, we've therefore opted not to reinvest all of it, but instead to switch some of that to bonds as well. Alternatives has also been slightly reduced, and the funds we hold are those that we hope would do relatively well if stock markets fall. They're there to try and hedge some of our equity exposure. If we turn to equities, you can see we've slightly reduced exposure over that period in favour of the high yield bonds, which should produce similar returns, but we've not made huge changes to allocation. The only real big shift within it is that we've increased Japanese equities, where we see decent value. And the US market has done really well, as we know, and we are a little bit wary about what might happen next. But rather than reducing exposure, we've hedged it by buying a form of portfolio insurance called a put option. And this means we'll feel happy to keep exposure relatively high, knowing that losses should hopefully be mitigated if the market does take a steep downturn. In our view, these moves have generally just slightly reduced some of the risk in the portfolios, but we still expect some decent positive returns given some of the attractive valuations in the market. So we hope you found this video series useful. In summary, at the moment we seem to be in a much more sort of stable environment than we've seen for some time, with inflation back down to more normal levels, economic growth being kind of slow and steady, and interest rates currently on hold, and hopefully the next move is going to be downwards. And that leaves us in what we call something of a Goldilocks environment, if you like. Things are not too hot, not too cold. Now, of course, we know that things like that, environments like this, don't last forever. Something will come out of the woodwork. Could be political, could be to do with the US election, could be something completely unanticipated. And so we do need to be cautious, particularly around some of the asset classes that have done really, really well recently, like US equities. But should this Goldilocks environment continue for a little bit longer, that hopefully should continue to be nice and positive for some of the other asset classes that we invest in. So thank you very much for watching. We'll see you again next time.